Business Finance Chapter 8. In Chapter 8, we talk about capital budgeting projects and analyzing capital budgeting projects. So, what is capital budgeting? This is long-term budgeting for an organization. When we're looking at capital budgeting, we're talking about very large expenditures in property, plant, and equipment. They are almost impossible to reverse. So once you decide to buy land and start building a new building, it's not very easy to get back out of it. And if you do try to get back out of it, there are a lot of costs. These, because they're such large expenditures, they usually involve several years of cash flows. It helps determine a firm's strategic direction, and then also the firm's strategic direction helps them decide what they're going to invest in for various projects. So, what do they hope for in the future, and how does that influence their decision about what projects to look at? When we're making capital budgeting decisions, we have to take a lot of things under consideration. The rules of whether or not we're making a good decision are we considering all of the cash flows for the entire project? Are we using the time value of money? Because projects last multiple years, we need to use time value of money calculations and discount future cash flows back to present values. Are we looking at the risk of the project? And then what are the various risks of the projects? How do we rank our projects in order? Can we afford to take on every single project that has positive cash flows, or do we rank them by emergency or by preference, or which one has the highest cash flows? And how do we decide what is more valuable to our firm when we're making decisions? So, is the internal rate more important? Is the fact that it just has a positive cash flow more important? So, what are all of those things that we find important about the decision? We've looked at all of these calculation methods in previous classes. So the first one we're going to talk about is the net present value. So how much value is created from undertaking an investment? First, we estimate the expected future cash flows. Then we estimate the required return. And then we find the present value of those cash flows using the required return as our discount. And we subtract the initial investment to arrive at the net present value. This is a calculation of the net present value, so it's the sum of the present values of all cash flows. The initial cost is often at year zero and is a cash outflow. So we have cash inflows when we're making money from this new investment, and we have what the investment costs. The decision rule for the net present value is that if net present value is greater than zero, we can accept the project. So if net present value is greater than zero, that means we meet the minimum required return for the risk level. The project is expected to add value to the firm. It has positive cash flows towards the end. It's a direct measure of how well this project meets our goal of increasing shareholder wealth. This is an example of a project that we're looking at. So we're looking at a new project and we have the following information about the cash flows, the net income, and the book value data. So this project is going to cost us $165. So we have a project that's going to cost $165. That is the cash outlay in year one. it's a negative cash flow, we're spending that money. And then, or in year 0. Then in year 1, year 2, and year 3, we have the cash flows and the net income. So remember, there is a difference between cash flows and net income because of non-cash expenses like depreciation. Our required return for assets of this risk is 12%. The average book value of the asset is $72,000. That's required for the accounting rate of return calculation. So first, we're going to look at the net present value for the project. We can use an Excel formula for net present value. We can use the net present value calculator on a scientific calculator or a financial calculator. We can also use the present value formula to discount each of the cash flows. So in year 0, we have the cash outflow. And then year 1, 2, and 3, we discount each one of the cash flows to present value at year 0. We add the positive cash flows and the negative cash flows together, and we get a net present value of $12,627.41. Because this is positive, this means that this project exceeds our required return of 12%. This is how you would input that information into a financial calculator. And then if we are using the net present value function in Excel, so the sum of all the present values of the cash flows, or the sum of the present value of all cash flows minus the initial investment. Or if you have the initial investment in as a negative number, which I recommend, you add the initial investment. That's the Excel formula. When we're using, why do we use the net present value method? One, we want to know that the project's inflows are sufficient to repay the invested capital that we're outlining for this project and provide our minimum required rate of return. We want to know that we're increasing our shareholder wealth, and it uses the time value of money. So there are decision methods for capital investment projects that don't use the time value of money, and those are not considered the best method of calculation. The net present value method meets all of our desirable criteria. We are considering all cash flows. We're considering the time value of money. We're considering our return, risk and return by accepting a risk rate or hurdle rate. It can help us rank mutually exclusive projects. So if we have projects that aren't dependent on another, we can decide which one, whichever one has the highest net present value would be our top priority. It's directly related in an increase to the value of the firm. It's also the dominant decision method for capital budgeting decisions. Usually, regardless of any other result, a positive net present value will be our deciding factor versus the other methods of calculating for decision analysis for capital budgeting, such as the payback period, internal rate of return, and the counting method. So now let's talk about the payback period. The payback period asks us to determine how long it's going to take us to pay back the cost of the project with future cash flows from the project. We need to know what the future cash flows from the project are, and then we're going to subtract the future cash flows from the initial cost until our initial investment is recovered. It's a break-even measure So we're just trying to figure out how much time does it take before we make enough money to cover the first cost of this project. The decision rule is to accept if the payback period is less than some preset limit. How we compute the payback period for the project. So we're still looking at this project that cost $165,000 in year 0. In year 1, we have cash flows of $63,120. So at the end of year 1, we still need to recover $101,880 of that initial investment. In year 2, we have $70,800 in projected cash flows. So at the end of year 2, we only need to recover an additional $31,080. In year 3, our cash flows exceed the $31,080. So to determine the time period between year 2 and year 3, where that gets paid off, you take the remainder at year 2 and divide it by the cash flows for year 3. Now, this is true regardless if it was year 4, year 5, year 6. It's the cash flows left at the end of the full year divided by the cash flows of the next year. So we see that we're going to pay it back in 2.34 years, or 2 years and roughly 3.5 months. The advantages of the payback method are that it's very easy to understand. It allows for the uncertainty of later cash flows, especially in very long projects where we have projected cash flows for 10 years out, but we know that those are just really rough estimates. It's really hard to guess what is going to happen in 10 years with a definitive number. It's biased towards liquidity. So how long does it take just to pay it back? Disadvantages are that it ignores the time value of money. There is a way to fix that. So you can do discounted payback method, which then you discount the cash flows to the current present value and then determine the payback method. So that helps to fix the time value of money question. It also requires an arbitrary cutoff point. So we might say we never accept projects that have a payback of greater than 4 years. So that means if we're using that as our decision method, we could be throwing out projects that are actually beneficial to us just because of this random 4-year number we've decided is the decision. It ignores any cash flows beyond the cutoff date. So once it's paid off, we don't think anymore about those additional cash flows that we're going to be bringing in. And it's really biased against long-term projects, which some companies need really long-term projects such as research and development, creation of new products, and other. The average accounting return. There are many different definitions for average accounting return, and there are different ways to calculate the average accounting return. So this is one of those ratio analysis calculations that changes depending on which textbook you're using. And if you Googled it, you might also find some different things. So think about how this book uses the average accounting return. So in this book, the average accounting return is average net income divided by average book value. The average book value depends on how the asset is depreciated. It requires a target cutoff rate. The decision rule is to accept the project if the average accounting return is greater than the target rate. if we're computing the AAR for this project, so then instead of the cash flows, we use the net income. This company has a minimum required AAR of 25%. We have 3 years of net income. So to get the average, we add those 3 years and then divide by 3. The average book value is given to us. So our average accounting return is 21.3%. Because it is not higher than 25%, we would reject this project. So what are the advantages and disadvantages of an average accounting return? I want to call it the accounting rate of return because that's what it's called in most textbooks. So if I say that instead or say ARR, it's because of that. It's called different things. It's calculated in different ways. Okay. The advantages, it's easy to calculate. The needed information is readily available. We have net income, we have book value. The disadvantages, it's not a true rate of return. Time value of money is ignored. It's based on accounting net income and book values, not cash flows and market values. And we know that net income does not equal cash flows. So if the item that we're looking at has a high depreciation amount, then this number can be completely useless to us. And again, where we use an arbitrary benchmark cutoff rate where we say it has to be above 20 or it has to be above 25.